So we have Jaco.
Phone's off, so don't text me during the thing.
Sorry?
Phone is off, so don't text me.
Okay.
You gotta roll over if you wanna say something.
He said it.
I sent him an email, and he said if you guys want an exam on Friday, no problem. But he's basically saying that we're gonna have we only have this fine for the project for next Tuesday.
He said we have the exam back to back. Okay, it's good. And then I'm so soon.
Or do we just have to keep on the side?
We have the project, and then that's due on Tuesday, and then the first midterm, which is in March, first period, I think the 13th, yeah.
And then we're getting assigned the homework for Tuesday class, if you're in that class.
Yeah, the project, yeah, he said he's gonna send out an email about it, so we don't know yet. As long as you have your group set. Basically, yeah, we don't have anything in this.
I really well over there on the place. Yeah.
I was doing okay.
Yeah.
It was kind of. I think last time was bad. It's only down.
You can ask, but then the question should be considered. Because you can't say, what do you consider, because you already answered that. So if you want more detail, you have to put the more detailed question. You see what I'm saying? Because I remember him actually saying that what kind of outcome they were looking for. So, not what it's the question, okay, so you want to at least ask a different question. So this is, yeah, but, so, yeah, so this depends on
What we need to do,
how much.
I think we have two things
There's
that
no
we must now know.
rule that says
All
you
has
have
to
to
be
have at the last of the semester. But that's the rule benchmark. Most projects will launch over because it has to do something. That's what I would say. In general, say, okay, this is the deadline.
But for us to you see, I always make a reference to the likes of work. You can't go by theory. There are lots of things.
No, that's the name
You
of
see,
the
that is the
business.
reason why it didn't impact
Sponsor these
their stocks. Because if it was a positive move, you would have seen the reaction on the market.
Give a project that they give strengths and resources. Sometimes they give data, they never give,
Yeah, exactly.
well, some
Yeah,
stuff, depends on what the project is. Yeah, right. But it's a real. It depends on what we end up. I think you know, data.
Are you relatively expensive or just?
Because even. No, yeah, even the summary, even the summary, I don't even think that's a problem, the summary itself. And then it depends, if it's a, if the data is numeric, if there's some numerical data, then you can do some calculations. If on the other hand, if it's all unstructured data, then you still get, you know, like a summary. The chair was like,
Yeah.
show them progress.
Yeah.
Usually they, one of the, that's what is happening. One of the signs that yeah. Executives say, the recommendation.
Yeah.
That's it.
We still have a start.
You know, last year, I
It's a popular start.
that they, these actually was also here with another company. That one sponsor said, well, give us a recommendation.
Yeah, they're all retrading.
So the okay, I mean,
And I added some
and
stuff.
also just the
That's the statement.
rate it up like, oh, 3%, 2%, it's just kind of the
You see, if you shampoo here,
everybody change 5 to 60,000. It's just,
yeah, if you go to Snap here and our cash balance is still like losing money. I suppose it's not that money.
we have like what? Overall, we have like
Yeah.
it's overall portfolio. That's you actually borrow money and the overall portfolio. So the overall portfolio is like 24%.
Yeah, okay. I can do.
You ran the code that you made.
All right,
Should we ask?
good evening, everyone. Welcome back. We stopped at, somewhere right after this point here. We realized there were two main ways of measuring rate of return, right? Why do we have to talk about it? Because rate of return is our bread and butter, right? There are two ways. One takes into account compounding, and that's the one we want to focus on, right? So that's the effective annual rate. Any other names that you guys know about PAR? While you think about that, And just a reminder, the other one, APR, does not take into account compounding, right? So it makes it easier to compute, to annualize and all that, but it's not accurate, right? So someone raised their hand. Yeah.
I was just going back to what you said about,
Another name for EAR?
yeah, it was, annual percentage yield?
Yeah, APY, right? APY, absolutely. So we need to be aware of at least those two names, right? We're not gonna care too much about APR, but see, here's the thing with APR. It's the measure of rate of return used in fixed income markets. So even that, you need to know and you need to remember, and that's why. Another name for APR is BEY, right? Bond Equivalent Yield, because it is the standard way of measuring rate of return in fixed income. And so let's remember that, right? So this is where we stop. So let me tell you guys what we're gonna be doing today. So once we remember these practical issues as far as measuring rates of return, we're gonna go into some conceptual issues, such as, okay, if we know how to measure returns, right? How do we come up with expectations of returns, right? From a statistical point of view. How do we come up with measures of standalone volatility, right? So we need to go ahead and learn what that is conceptually, and then what that is actually measured, how it's measured practically speaking, and then we're gonna start having fun with Excel, right? So that's the plan for today. So let's start with, so let me actually, yeah, so I guess this is working. Let's start with the concept, right? So, now, potentially, there are multiple ways of coming up with projections of returns, right? Expected future returns, right? Your imagination is the limit. However, in finance, we use statistics a lot. Why is that? Because in finance, we have a lot of historical data, right? So if you have a lot of historical data, why not use it as baseline for your projections? And in fact, that's what people do in practice. And then, of course, they use additional sources of information to change those baseline projections to make it more realistic. Because, of course, as you know, whatever happened in the past may not necessarily reproduce itself, right? But at the core, we're still using historical data. And the ideas behind using historical data are statistical ideas. So, for example, when we say we want to come up, I don't know if this is going to work, but it's very short today. So when we come up with all right, that works. So when we come up with expectations of returns like this, we're talking about statistical expectations, and what that literally means is it's an average, right? So average, what does that mean? You have to have, in order to come up with an average, you have to have some sort of a scenario where you have the actual return value, right? And you have to have the probability of that scenario. statistically speaking, when we use this idea, right? The assumption is the scenarios we've come up with, they're a perfect description of the world. Of course, that's theory. That's why whatever I'm gonna talk about here is concept, and then we're gonna actually use data and make it operational, right? But the concept is we have all of the scenarios, and so we know for every scenario what the rates of return are, and we know the probability of each one of the scenarios, right? And that's how we end up computing the theoretical expected return by just computing the weighted average, right? Hopefully this is not anything new to you guys, but it bears reminding everyone, basically, what that is, because we're gonna go further into this. Virtually all statistics that are computed are averages. Here's the first one, right? Expected return means average return. Why am I saying that? Because if you look at, for example, this is just a numerical example, right? These are all the possible scenarios, and somehow we know the probability of these scenarios, and we know the outcome for each scenario. By the way, technically speaking, it is possible to have something that's like this, if in fact we have very long observations of this variable we call rate of return, right? That's the idea. Basically everything you see are what's known as steady state results. So once you have virtually an infinity of observations of that particular rate of return, then you have compiled all of these possible scenarios. Does that make sense to everyone? Right? That's the general idea. Sadly, in finance, we never have that infinity of scenarios, so we have to, do something that makes it still technically correct, but not quite the way I'm presenting it to you now. But everything we're going to be doing is based on this idea, right? So you compute the weighted average return, and in this case it happens to be 9.76%. It really does not matter. The only thing I meant to illustrate is that this is the first average we're going to be computing, right? Typically, in finance, it's you come up with a weighted average like this. Then you want, whether we talk about a stock or some fixed income instrument or a whole portfolio like your portfolio, right? If we want to measure stand-alone risk and make sure you understand this, meaning, for example, when you talk about your portfolio, I told you guys, this should be a portfolio that any individual could invest into. Remember that, right? So they don't have to invest anywhere else, it's just your portfolio. And that's actually how we're gonna look at your portfolios, right? So, therefore, whatever risk of that portfolio, automatically it's a standalone risk, correct? On the other hand, even though we can also measure standalone risk for individual stocks, and it's going to be exactly the same thing as portfolios, maybe standalone risk for stocks is not the right measure of risk. You know why? Because they don't stand alone, right? You put them together. So maybe that measure is not the right one, but we still need to know, because it does have an effect on everything else. As we will see, we still need to know how to measure standalone risk, even for individual stocks and bonds and whatnot, not just portfolios. Now, check this out. So I told you virtually all statistics are averages. So for example, you guys have heard of variance. Let me check that. Raise your hand if you've ever heard of variance. Excellent. Did you know that, okay, actually, let me ask you to define variance. Who wants to do it? Let's say you're in an interview, and it's a very basic question, but let's see actually if you guys are able to answer the question. So in an interview, they say, well, okay, can you define what the variance is? How would you guys define that?
It's the sum of the squared values of each individual measurement from the mean.
Some of the what?
It's a sum of the squared difference between each individual measurement and the mean.
Yeah, it's very close, absolutely, right? Because that's what the formula says, right? Anything, but what I'd like is use what Cliff is just saying, tweak it a little bit.
Another way is the difference between the actual and the expected.
No, of course. And Cliff said you have to square that out because that's what's here. But I want it to sound like something that's understandable without a formula. And still using what Cliff has just said. Malcolm, go for it.
Well, like it's a statistical measure that measures the spread between the results.
Okay, so all of these are very close, right? But because I told you guys virtually all statistics are averages, I think that's, you should start with that word. Go for it.
If I'm planning to like explain it in more like specific example, is that if like your return is like a normal distribution graph, that your variance is the distance between your, if you are having like a mu in the middle, the variance is the difference between your distance from the left side and the right side.
Yeah, so all of these are very close, right? All of these are very close, absolutely. So let me tell you what it is, because that's actually, let's go back. You guys, oops, sorry. What? Okay. No, that's not it. So, there you go. Remember this? What is this? This is the definition of expected return. It's the average of all possible returns, correct? That's how you should read this. It's the average of all possible returns, right? So when you read, how do we know? Because these are the main objects, the returns, and these are the weights when you compute the average, correct? All right, so let's go back. So now, you guys want to use that word average? Phone?
So variance is the measure of the difference between the average of the square difference between the average. No, sorry.
Yeah, I know it's
The
confusing, but
The average square.
let me. So you speak slowly, and I will circle what you want to say, right?
Yeah.
So these
square
are the
difference.
objects, and these are the weights,
Yeah.
right?
The average square between the difference between the data and the return and the mean.
Yeah. Basically variance, so you should write it down. Variance is the average squared deviation from the mean. Variance is the average squared deviation from the mean. That's the definition, that's how you should remember it. Don't remember formulas. It's an average. Average of what? Of squared deviations from the mean. Right? a similar definition, if because I wanna make sure we're all on the same page. A similar definition would go, variance is the average squared deviation from expectations, right? From the expected values. Variance is the average squared deviations from expectations. There's expectations, and you take deviation, all the possible deviations, and you compute the average of these, the square of these deviations. Why? Because you want to have some sort of a sense of how far from expectations our rate of return will actually fall, right? So you need to understand it like that. Don't try to learn formulas or anything, right? It's the average squared deviation from expectations. So some of you will wonder, so that why don't we just compute the average deviation from expectations? Why do we need to square them, right?
They cancel out.
Huh?
They cancel out of the
That's
negative
right.
positive.
Right? If you have any sort of projections, that's your expectation, and you look at every deviation, the average deviation, right? Average means expectations in statistics, right? So the expected squared deviation from expectation, that's what variance is, right? Why do we need to square it up? Because the expected deviation from expectation, think about that, it's in English. I know it's confusing. But the expected deviation from expectation, by definition of expectations, is actually 0. And why does that work like that? Because the positive deviations cancel out the negative deviation. That's actually how average or expectations are defined, right? It's defined so that when you sum up the deviations from it, it's 0, right? So instead of summing up the deviations to compute the average, let's sum up the squared deviations, so the negative deviations become positive, right? So that's the idea. So that's how you should remember variance. So we cannot compute average deviations. We have to compute average squared deviations, correct? That's why there is no name like average deviation. The name that we all know is standard deviation. When you compute the square root so that it square root of this, so that we have some sort of a deviation from the mean. That deviation is what we call standard deviation. We cannot call it average deviation because that's 0, once again, by definition. Questions about that? So this is the second average we're talking about. At some point in time in the semester, maybe we'll talk about others. But all statistics that you've heard of, most of them are averages, right? Like this.
Are you recording?
That's a great question. I knew I forgot something. So let me try. Let me do that. Thank you, Peter. So maybe from now, just remind me every time. Because
Sometimes I also forget.
then someone else will remind. Thank you for that. So just for the record, let me confirm that when we were looking for expected return, right, it's simply the weighted average of individual returns, right, where the weights are the scenario probability. And so when we look at standalone risk, as measured by, let's say, variance, it's the average of the squared deviations from that expected return. Right? And because we do not like to play around with percentage squared, which is the unit for variance, right? We want to play around with percentage, right? So we take the square root of it because we want something that measures some sort of deviation from the mean. So we take the square root, and that's the standard deviation that we will be using. Any questions at this point, right? So all these points are conceptual, right? Now, this is just a numerical illustration, right? First, we need to have this expectation before we compute individual deviations from that expectation, and then we have to square it up to make sure that negative deviations become positive and do not cancel out positive deviations, right? Okay. And of course, the standard deviation is the square root of this. In finance, we do use these two measures of standalone risk interchangeably. You know, sometimes people just use variance, and sometimes they use standard deviation. And we know how to go from one to the other, right? That's the general idea. Now, here's the problem. And I mentioned this to you in maybe different words. We will never have all of the possible observations of the rate of return of any stock, right? Because there will always be something we have never observed, right? And that's all that I'm saying here. For those of you who know statistics, basically what we're saying is we don't have the population of rates of return. All we will ever have are samples. Does that make sense? Right. So when we use samples, we have to change the way we compute these averages. So let me show you how. So first of all, when we look at let's say and observations, right? When we look at the average, it's still the same thing, but because we use historical data, every time you observe something, let's say you have 60 observations, right? Then your estimate of the probability of each occurrence is 1/60, right? This is why when we compute simple averages, which is what this is, you just add up all of the data divided by the number of observations, that's it. But literally what you're assuming is that the probability is 1/60, right? Okay, it's an estimate. So that's number one, right? Instead of the actual theoretical probability, these are estimated probabilities. I'm hoping you realize what I'm saying. What I'm saying is, if you had some other sample, even if it's the same stock, but you use some other samples, maybe the average, not maybe, for sure, the estimated average would be different. Does that make sense? That's of course what makes our job difficult in finance, is because number one, we always have to forecast, you know, as opposed to say accounting where you report on what has happened. You always have to forecast, and worse, then you have to make decisions based on the forecast. Like you guys make decisions, oh, let's invest in whatever because we think it's gonna be great, right? So these are the two difficulties, and that's what this illustrates, right? This is the probability of every scenario, and all you do is compute the weighted average assuming everything you observe has equal weights. That's number one. Number two, when you compute variance, here we go. So when you compute variance, it's what you're measuring is the average squared deviation. You'd like to measure the average squared deviation from the mean. But unfortunately, what you're measuring is the average squared deviation from the estimated mean, right? So this is an estimate, correct? This estimate uses the sample, right? So let's say there's what did I say, 60 or maybe 60 observations. Now, every time you compute, this is a statistic, right? Variance or standard deviation is another statistic. Every time you compute a statistic where you use a previously computed statistic, what are you doing? You're saying I'm using 60 observations, but because I know I have a fixed estimate for the average, right? Basically, the actual observations I'm using for this new statistic is 59. Why? Because if you know the 59 observations, you know the last one based on this. So statisticians call that degrees of freedom, right? How many actual observations are you using? How many observations give this information? Is it the whole 60? And the answer is no. Because one of those 60s have been used up here already, right? In other words, if you have 59 observations freely moving, but then you fix the average, then observation number 60 is known in advance. Right? You guys understand this? Right? So when we compute variance, instead of dividing the squared deviations from the mean by the number of observations, divide by number of observations minus 1. Right? And of course, this expression happens to be the standard deviation because I'm computing the square root. Any questions on this adjustment? Right? So that's just an adjustment so that we have an unbiased estimate of standalone risk. Meaning, if we collected many samples, right, and we computed standard deviation like this, and variance as by removing the square root sign, if we did it like this, then it turns out when you compute the average variance, it's going to be the real technically correct variance. That's the reason for this. All right. So, as long as we all are aware of this, I think we're ready to go. So on Husky City, let me make sure it's there. Well, I know it's there. What we're gonna do now is go into the practical, start using data, right? And if you go into the weeks 3, 4, 5 module, you can download an Excel workbook called Morningstar Direct Return. I'd like everyone in this room to do this. Let's download it on your laptop. And I will walk around checking that you've done so, and then we're gonna go from there. this is my word. You have to get there. That's the plan, right? Right now, so by a show of hands, who has the data? The data is just gonna be some old data on IBM and AT&T, right? So that no one can claim, oh, I did that, or I can use it for my next assignment. No, you have to download your own data. All right, so let me know once you have this on your, when I say this, it's just columns A, B, C. That's all you should have. So when you have it, raise your hand. Okay, so let's wait some more. Because we want, we meaning I mostly, I want everyone to have this in front of us. So again, it's on Husky CT, weeks 3, 4, 5 module. And the name of the workbook, the Excel workbook, is Morningstar Direct Return. And if you don't have it, just sit next to someone who has the laptop and or the data. And because you need to be able to follow what we're going to be doing. And as you do that, let me describe what the data is, right? So these are clearly monthly data. They're actually monthly returns, right? So for example, on February 28, 2011, end of trading day, IBM returned for the whole month of February 0.3%, and AT&T returned 3.1% for the whole month. Right, so these are all percentage rates of return, monthly return. All right, so now by a show of hands, who has these 3 columns A, B, C in front of them? Okay, good. So let's do this, right? So the first thing we want to do, of course, given that these are historical data, is to apply what we've learned, right? First thing is let's compute the average, right, based on this historical data. And like I said, we're gonna use this in a lot of context, and in practice you want to use it and then change it, right? But you have to have some baseline, otherwise it's just out of the blue, and you do not want that, right? So, okay, so let's compute, let's say the average, how am I gonna show that? F4. Oh, there you go. Right? So, how do you compute average? Hopefully we've all done that, but today, starting today, we're gonna practice all of these things. So, compute the average by using the average function, right? So, how to use a function? Equal average, open parentheses, and you select all of the data, and then close parentheses, and that's it. You get your average on Excel, right? So I know this is very basic, but we need to go through this. And by casually looking at the data, you notice that IBM had a lot of negative months, right? You guys notice that? So again, equal start typing, equal average, and then open parentheses, select all the data, close parentheses. Raise your hand if you've done it. Okay. So, if you've done it, you notice that the expected return for IBM is negative 0.2%, right? Already, there should be some questions in your mind, right? If that's my prediction for IBM, why in the world would I ever invest in IBM? You guys see the idea, right? And this is not a fake data, this is real data, right? So, okay. Oh, by the way, how would you guys, if you have this formula already, right? How would you compute the average for AT&T? Could you do it? You could do the same thing, enter equal average and then select the data, right? Or is there a shortcut? Anyone?
Copy and paste.
Just drag it,
Average and control.
right? Because you take this, right? You can take this and just drag, right? Because when you drag, the formula automatically transposes to the next column, right? So just based on returns, expected returns, looks like AT&T's expected return 1% per month, IBM expected return 0.2% per month, right? And, you know, maybe we should all just buy AT&T and short IBM. Right? That's the point. That's the point. Right? Okay. Any questions so far? Right? So, all right. Guess what we're gonna do next? We're gonna try and estimate standalone risk, right? As measured by variance and or standard deviation, correct? So how do we do this? You guys convinced me, after I convinced you, that basically variance is nothing more than the average squared difference from the mean. So, for example, let's look at this, right? Take a look at this. What did I just do there? Can anyone describe what I've done?
You locked the mean value and then you subtracted all the other values from it and squared it.
Yeah. So literally for every observation, right, which is B2, the actual rate of return, right, I subtracted the previously computed average, right? By the way, you notice that there's dollar signs before the letter and the number, right? This is just like Cliff is saying, so that when I drag the formula, that does not change, right? So I computed the difference between the observation and the average, elevated it to the power of 2. And I want that formula, you know, I want to get that formula and click and drag it for IBM. So let's do that first, right? So let's do this. Right? Let's type this formula in. Equal, open parenthesis, select the actual return for that particular month, minus the average you've computed. Don't forget to put dollar signs all over the place for that one. I forgot how to do that. Does anyone remember how to do that? Yeah, go.
F4.
F4, there you go. F4, while you're somewhere, or in the middle of E2, you just press F4 and it does the dollars for you. Close parenthesis and then elevate it to the power of 2. And then drag that formula down and you're gonna have it for IBM. You're gonna have a list of squared deviations from the mean. Raise your hand if you have it for IBM. Okay, let's wait some more. There's no need to rush, by the way. We need to make sure we all are on the same page and we're all fluent with doing this, with understanding this. And for those of you who are done, you should do the same for AT&T, right? Take a look at this. Right? I did exactly the same thing for AT&T. Right there. Right? Exactly the same thing, and then you drag it down. Okay, so who's done with the IBM column? Good. So let's do this for AT&T. Do not forget to select the whole data, right? This goes all the way. So I literally have like 60 observations, right? Starting in row number 2, ending in row 61. Oh, yeah, row 61. Who's done with the AT&T column? Okay, so now let's summarize these columns. How do you summarize a column? Compute the average, right? So here's what we're gonna do. Check this out. Can I use the average function? No. Why? Because I thought we agreed that variance and standard deviation are using the mean, the estimated mean, right? Because variance is the average squared deviation from the mean, right? So once the mean is estimated with a sample, then you have to subtract 1 from the number of observations that will actually produce information for this particular statistic. So all we can do then is sum up all of the observations, yes, all 60 of them, sum up all of these calculated values, and then divide it by 59 as opposed to 60. So let's do this, right? And when you're done, just raise your hand so I have some idea that you're done. We're gonna wait some more. And again, do not rush. The best thing you can do for yourself is to make sure you get this right.
Sorry, just put me to draw 5 and I did the average for IBM.
Yeah.
AT&T, and then the
Square difference from the mean.
Yeah, what's the next one?
So do you have columns H and I?
Oh, so the other one is for AT&T, right?
Yes.
Okay.
Column I is for AT&T. So it's the same, let me show you. It's the same formula, but, right? It's observation on the same row, the actual return, minus the previously computed mean for AT&T happens to be F2. Dollarize everything, close parentheses, and elevate it to the power of 2, and then drag it down. Right? And then the next step is to compute the average of each column. But now we're very aware of the degrees of freedom stored, right? Because we're using another statistic, which is the mean, which was previously estimated. So every time you use a statistic, you lose 1 degree of freedom. And so, again, so Peter, the next step is for IBM, sum the whole column up, divided by 59, number of observations minus 1. And you do the same for AT&T. Raise your hand if you're done with AT&T doing unadjusted. Good. All right. What did we just do? Come up with an estimate of standalone risk. Right? And we measure it in this particular, for now, we're measuring it with variance, right? By the way, which one is riskier? Based on your results, which one is riskier? It's not a trick question, just IBM is riskier. So let me get this straight. IBM has a negative return and it's riskier. Why do you like IBM? You guys see the idea, right? Now, you notice that I have a second row that has exactly the same results. How did I do that? Well, I use an Excel function called, let me remove this out of the way, called var.s. Who wants to guess what that means?
Sample var.
Yeah.
It's population
Sample
var.
variance. Right? So var.s, so we have to use it too. We have to have that experience. So equal var.s open parenthesis. Please remember, when you use these functions, you don't use the calculated columns. You have to use the original returns, right? Because you want to compute the variance of the returns. Right? So var.s open parenthesis, select the original IBM returns, and then close parenthesis. And you do the same for AT&T. And you should have exactly the same numerical results because that's how it's computed. Right? And as I've mentioned, and you've noticed, IBM definitely is riskier than AT&T based on these data. Questions so far? So raise your hand if you're done using the var.s function for both IBM and AT&T. Again, don't raise your hand if you're not done, because we will wait for you.
So we should get the same number.
You should get exactly the same number, the same result. By the way, so as we wait for more people to be done with this, if in an interview you are asked to read the variance for IBM, how would you read it?
It's percent squared.
There you go. It's 20.3% squared, which is not a very popular measure, obviously. Do we all understand it? Variance, by definition, is in percentage squared. In practice, a lot of people quote percentages, and you have to be careful, right? Because whatever percentage, you have to divide it by 100 again to make it a real variance. All right, so this time, raise your hand if you're done with the variance function report. Okay, good. So guess what I've done next, right? I went ahead and you guessed it, estimated standard deviation. How? I took my variance estimate, elevated it to the power of half, which is the same as taking the square root, right? That's all I did. So let's do that. That's easy, right? Just take the result you have already in J2. So equal J2 to the power of 0.5. And then drag it to the right to compute the same thing for AT&T. So raise your hand if you took the square root of variance for both IBM and AT&T. Okay, that's good enough. Now, you guessed it. I wanted to show that you can get exactly the same result by using, guess what? Standard deviation function for the sample. So stdev.s, stdev.s gives you exactly, it should give you exactly the same result. Now don't skip any of these steps. You absolutely have to have, when I'm asking you if you have these results, you have to have them. You know why? Because we're gonna use these results to go further. So if you skipped something, then you're just gonna be lost. So to recap, right? When we estimate variance, we can use the definition that an estimated variance is nothing more than the average squared deviation from the mean, and making sure that the weights are 1 over number of observations minus 1, right? Because we're using a sample. And we should also realize that we can, in fact, get the same results by using var.s in Excel. Right? In the same vein, you can get standard deviation by computing the variance first, and then taking the square root of it, right? Elevating to the power of 1/2. You can do that, or just use stdev, standard deviation, .s once again. And when you use it once again, you cannot, as argument for the function, you cannot use the calculated columns. You have to use the original return columns, right? So raise your hand if you're done using stdev.s. Right? You have to experience it. You have to have done it at least once in your life, right? Okay. So if you had to guess, first of all, clearly, IBM did not disappear, correct? So people invested in IBM. So if you had to guess, here's a stock that has, that's expected to have negative return and expected to be more volatile than AT&T. So give one possible reason why people were still investing in IBM.
You have such a small time span.
Huh?
You have a small time span.
Small time span?
IBM existed for a lot more years than the 5 years you had
Oh, I see. So Cliff basically is saying, well, maybe the sample is too small. Maybe. Right. But that's a problem, isn't it? If our estimates depend on the sample size, correct? Yeah? So when are we gonna stop? We're gonna find the size where the return is positive? That's a no-no. Okay? That is a no. If you're gonna use statistics, you have to use it as, what's the word? As honestly as possible. So let me make a point here, because that's pretty clear. Thank you for that, Cliff. So Cliff did not say what I just said. He inspired me to say it, right? But he said, oh, this is too small. So I'm saying, oh, wait. So maybe if we had a bigger sample, the estimate would be positive. You guys understand that, right? That approach is not statistics. If you start selecting the sample size so that you get a positive return. Because the whole idea is, the whole assumption is based on these returns to be totally random. Do you guys understand it? So because it is random, the estimate of the mean and the estimate of the variance, they too are random. Do we all agree? It's random because it depends on a particular sample. Do you guys understand this? So it should be random. You cannot choose the size of the sample to fit what you need or what you want to see. Right? So that's the first thing I want to make sure you understand. Right? Now, having said all that, if we now use what's known as data mining, also commonly known, well, it's part of AI, really. Then we can do whatever we want. But then we're not using statistics, right? These are two very different approaches. Any questions about that? Right? I'll talk about AI at some point, but today it's pure statistics.
So you're saying it doesn't matter like what time we use?
Yeah, it's as long as it's random. I chose this, I chose 60, and it's a totally random period. As long as it's random, it's fine.
And it should be consistent, like example, like end of the month or something.
Yes, absolutely. Oh, thank you for that, Peter. So Peter is noting the following, is that when you, yes, it should be random, but make sure that the data are matching data. They match one another, right? So the returns for IBM and AT&T were collected at the end of each month, for example. Because it's going to be another problem if the data are mismatched. So in that case, even AI does not work, right? But bottom line, let's be rigorous. That's the key, really. You have to be rigorous. Why? Because then when you lose money, you can point to the fact that you were rigorous. Does that make sense? You need as many arguments as you can once you lose money.
So we
Okay.
definitely need the same thing.
Yes.
IBM and AT&T.
Absolutely.
But it's randomly in terms of like, I don't want the end of the month, I want like middle of the month.
You can do middle of the month for both
Yeah,
stocks,
both.
right? It should be the same day, end of the day return, something like that, right? So that's the idea. So rigor, that's the key. As long as you're gonna use statistics, make sure everything you do is based on a random sample, not a chosen sample. Right? Okay. Other questions about it? That was a great point, because again, and you may not realize it, when you use, for example, data mining, literally part of data mining has to do with finding the data, the subset of data that would give you something, And why would that subset work better than some other subset? We don't really know. That's the whole idea. But it works, right? One of the better hedge funds, I think it's Renaissance Technologies or something. One of the managers was saying something like their best strategy. We remember that hedge funds use multiple strategies. Their best strategies is an algorithmic trading strategy. And it makes a lot of money, but they have no idea why. Because it's not based on math or statistics or anything like that. It's based on literally what I told you not to do, which is, choose some subset of data that makes it look good for you and see if you make money out of it. And they're using it and they make money, but they don't know why. But that's why they make money, precisely because they don't know why. Precisely because their competitors cannot replicate it, right? You guys know the story, right? If you do something and everyone else understands it, that's a problem. If you buy IBM and everyone else knows it, everyone else knows that you know something about IBM, they're all gonna buy it. And by the time you place your order, it's too late. The price is very high. You guys see that. So that's the general idea.
But by the way, to your question, unless lets you trade, I mean, like through the probably when you saw your market data.
Yeah.
No, but like order data. So is it anonymous? Like you.
So this is why. So you guys remember, at some point I was talking about dark pools. Right? So dark pools were invented a few decades ago, literally by financial institutions who traded among themselves mostly, but they invented it so that they would not suffer the phenomenon that I've just mentioned, which is that if you do something and everyone else knows that you're doing it, by the time you're done, it's too late, right? If you want to buy IBM, first of all, you have to break it up into smaller trades and all that. And people are very fast at discovering what you're doing if it's not a dark pool. So by the time you're done, everyone else would have bought some shares of IBM. And we talk about slippage. Your slippage is going to be very, very big, right? So anonymity is a huge asset for sure, right? Either that, or you're not anonymous, but you have no idea, and therefore no humans has any idea what the strategy is, based on how it works.
But if you don't trade in dark pool, but you don't use platforms that serve order data, then you are not anonymous or anonymous?
So generally speaking, you're still, it depends what we mean by anonymous, right? We are never 100% anonymous, correct? Someone minding the system knows. Does that make sense? Right? It's just a matter of degree, right? Dark pools are set up so that there's very few humans in the loop.
So if you figure out a good trading algorithm, it's better off trading in the dark.
Yes, for sure. Right. So the comment is, if you figure out some algorithm that makes money, it's always better to be anonymous. It's always better to trade in dark pools. Malcolm.
But isn't it random, like, it's randomized?
That's the So for a long time in finance, finance purists always were making fun of people using AI, because the AI part that people are using were like Renaissance. It's what they called it data mining. Data mining was supposed to be something that's very negative. Like, remember this idea? Let's mine the data so that I end up with a sample of IBM return that gives me a positive average rate of return. That's data mining right there. And you're not supposed to do that. Well, you're not supposed to do that if you use statistics in a rigorous sense. But there's an alternative, which is let's use AI. That's a totally different thing. Because AI means let the computer do its thing, right? And let's see if it works, right? We're not doing that. We're doing the statistical thing, right? Okay. So, I think I still did not get my answer. So I'm gonna ask it again and have you guys think about it, and then we're gonna take our break at some point. But my question is still the same, right? We did this totally honestly, randomly, as we were supposed to do. And it turns out the expected return for IBM is negative. Worse, its volatility is higher than AT&T. So why in the world were people still at that time still buying IBM?
They expected to buy low, selling high, or like.
So yeah, so one possibility is they just like risk. Even though the expected return is negative, they still kept. So yes, they are gamblers in financial markets. However,
Were they both paying dividends or one paying a dividend?
no, they were paying dividends for sure, right? But here's the point, so one possibility for sure is that the people who were holding IBM shares were gamblers. However, I want to make sure you understand something. Financial markets are populated by a majority of risk-averse operators. That is a fact. Yes, there are gamblers, here and, like a minority if you want, but the majority, the vast majority, with the most buying and selling power, are risk-averse. How do we know this? Well, we know this because it is true that when a particular instrument or asset becomes riskier, guess what happens to its value? When a particular asset or instrument gets safer, guess what happens to its value? It goes up. That's how we know. It is a fact. Right? So, but it is a possible explanation as to why. Right? Someone likes a lot of risk and maybe does not trust, they don't care about the negative average because they think there's still a probability that it's going to be positive. Right? Yeah, that's a possibility. Right? However, it's, let's say we're going to take the break at 45, so I'm going to take the next 2 minutes to explain what's going to happen, is that maybe one dimension we should be looking at is how these two stocks move together. That's what we're going to do after the break, right? We want to take a look at how they move together. Why is that interesting? If they tend to move together in the same direction all the time, then IBM is a really bad stock. But maybe, just maybe, this is not true. Maybe IBM does not always, and maybe most of the time, it does not move with AT&T. And we can speculate all we want, but when we're after the break, we're gonna look at the numbers. and then we're gonna find out if that's true or not, right? So let's say it's 45 plus 15, that's like 8 o'clock. Let's all be back here at 8, and we're gonna continue this discussion.
So you want to charge yours during the break? And then first, I'll charge mine during the break?
There's one in the front.
Oh. Wait, so if we unplugged it, or else, I'll plug it up there, I guess.
Almost one. That's the data.
Is that just?
I'm fine with it, but I figured it makes sense that each of them are 50,000 more like that. So it's just too difficult to make this work for I think if it's something really dependent on labor, it doesn't really change that.
I think there's like averaging has to be considered like average rate.
So what do you guys think about that? Think it's gonna go up?
I think so.
What do you
I
think
don't
so,
know.
right?
I'm pretty confused.
So they have
I don't know what's going on with the earnings at all. I mean, there are many companies who have exceeded their expectations, but the stock's still going down after the release of their earnings. I don't know what the fuck is.
That's not based off of retail investors, that's based off of
Institutional
earnings or something.
What is it that they know? I mean, what's going on here? I don't know. It's not even.
For a year.
Technically,
stuff is
the
when-
stocks should go. Do you guys wanna go outside?
Yeah, we'll go outside.
If we are having
But even with the
a
app stock, it's still
almost
sitting at
one
45.
But
That's
realistically,
not.
this is kind of right. It's really this
Why-
for
why-
Yeah, we can ask this one exactly.
March, April, we do this for three months.
Yeah, and that's just like
So
divided
we
by
have
3.
four.
Divided by 4.
So it's $2,500. That's not.
And that should be 4 divided. That should be times 4 divided by 12.
$2,500.
That's just, no, this one is just for if we are, like, if this actually having a profit that is like exactly 77K. What if this stocks are below 77K? That means your cash flow equal on timing times 2. It would be very huge. But if we don't have like 77 already, like this 163. That's the loss. So right now I'm talking about 77. If like there, so if like this is like stocks, we know
Oh, it's
that
moving
batch
forward.
is 77, that's 3K. So like buy the stock, if we have 63K, because I'm just thinking stock. That means this is the interest worth of 4 months. Yeah, I already divided by 4 times. 4 times. That's why I'm not doing average. Yeah, it's fine. It's like just convince me. Just try to convince me. Okay.
1.6% on like whole portfolio for like a quarter, that's what if like that thing goes up like the other part like goes up 5%. The other we just trying to buy.
Doing the 3 goes up by 5%. It means like we don't need to care about the average. So like the average means that if you are earning a profit, yeah, you don't need to care have here,
And
and also.
another thing is this already done, so practically we can put zero here, whatever, that's where we are.
Which part do you need to?
So we have already that negative whatever on that position.
Yes.
So we have negative, but practically we can consider like that's where we are now. Doesn't matter what happens with the-
Yeah, like, so, this is nothing happening about like here, this is only happening under if we are doing like any math option, that's our only law should buy the stock. Nothing to do with the budget.
Okay, so practically you are saying we are not going to go with that's what you're saying. That's the interest we are taking.
Oh, you mean that one? Yeah, I'm just trying to not to leverage the leverage or
Okay, so but practically without this whole competition, the bottom line is you are saying no matter what we are doing, we are not going to overcome the leverage, the margin.
and it's like for this one, we're having all.
Okay, but then you practically say we never should do it.
Like we are having like profit or like we're like, I
But
mean.
you don't know, but we have like, we have only minus one percent, that's where we stop, like, we can say, okay, we stop at interest only, or we stop at like $900,090, and then now what do we do? So practically with this one, you are saying, no matter what you're doing, you use leverage, or you always use money.
No, there's nothing to do with lose money. That's the thing is that like. So this cash inflow is for when you are selling all this LEU, which is like this like 7,000. And if after we are selling all this, I'm not planning to sell it. So if we are selling all the stocks, or if we are earning a profit, which is like we pay, that's the cash inflow we like reselling. And the outlier is that, okay, we are borrowing like 77, and then we're going to pay 77 to buy this. And also, we need to consider like, loan for 77, but it's this is the cash that we need to be
Okay?
at least like at the end of our like
That's, okay, that's for the quarter, okay?
so that's just the cash.
So we have like what, the difference would be like $3,000.
So if like with like if we are having like 80K profit, like if we are having like only like 3K profit, that's like basically we are having like 80 cash flow, like 3K profit, we still need to pay. For your cash flow and cash outflow, it's hard to look at.
This is what we get, okay, so this is without, this is without the future.
So if you are having this two, you could click this one, see how I can. So that's our true stuff that you can take out in cash. That's our the only cash inflow we have.
Okay, so practically this is what we,
Okay, for,
okay, this is the loan what we have,
no, this is the cash outflow for paying by the stocks.
okay?
So like stock pay.
Okay,
This is the inflow for like if we are selling all the stocks.
okay.
And if we are selling out you, so if like if you add this to that, it's different.
And then you are saying we have still lost out. Okay, but then we have already lost, but still much better than that, I mean, therefore, compare what we have.
Even if we are having profit in here, but right now we want to look at this like, if like it's not profit, what makes sense, if it's like, we are having loss,
regular position. He's drawing like 60 or 70,000. It's compared to 400.
Yeah, that's me.
But what if we put on high?
But if you don't do anything, then if you do that, then you do only 400.
This is, if we are doing, if we are doing nothing, that's
That's better if we are doing something.
well, that's not.
I mean, what I'm getting here, you're saying you never reach it because then you do really bad.
No, I'm just lost on my head and like almost all locations, I don't know why. Always just
I think this is a good idea, but what I'm trying to say, without going that kind of calculation, just like, just use the children like the 5% of my cities, like, I don't know, 50%, or 1%. It's just really hard
Let me
to,
show you.
it's really hard to track. I mean,
50%
it's-
or 5%.
Yeah.
Each are split. No, I mean like consider we are having this one amount of money as is, or do you still want to have like cash balance?
It's not like just to spend.
If it's 5%, it's like not reachable.
Utilize the amount on here.
Because I
said,
think like
I
all
don't
this one are like
carry-
100% of the 77,000.
I said, don't go to cash balance or following here, some crazy, I don't mind.
No, so like what do you mean? Like 5% of what amount?
Each of these positions should be 5%.
Of like total invest or like 1
50,000.
million?
You can use like all positions.
What amount? Did you say?
5% of the one. So
5%
only
of
50,000.
okay.
Otherwise, it just doesn't move the needle. It doesn't do anything.
This is you
Yeah,
alone.
spend time on doing strategy, it doesn't make a
And it's
difference.
so true for some administrators.
We like this separate in percentage.
I don't believe that they're very sure.
That's the, these are very important. Do you remember my original date beta is that 1.03 I'm trying to make it instead of like. But the closest one is
Yeah, but if we have little wrong, then inflation is rising.
So I know the stock market is to go fast.
But, you know, you're just looking at something that is
No, 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 no,
that's why I'm buying more on
Maybe that is something. But there's a long time to go. Yeah, but then why was we so restrained? When it was all about all of that is crazy. And later on,
all that, like double that, all that. That also went down like, PCA, so I just dropped my cost to like 70.
maybe I'm not so did something, maybe it's just, I don't know. I mean, like, I don't really feel like so bad, like maybe, like,
So let's say I invest in my fund, so that I have more time. Then over time, whenever I see it, I buy it. So I'm averaging my position in a long-term scale.
Yeah,
So
but
I
that's
drop
right.
my position all the way from
Professor, yeah.
100
The spectrum, I mean, if you calculate it properly, like, margin interest rate is 13.5%, which is really above.
It's not above, somewhat above.
I stopped there.
When's that, that's the interest rate on margin?
Yeah, it's a really penalizing. I think 13.5 is like a kind of.
So the only reason you would wanna do it is if you're investing in something that's even riskier.
I don't see any.
She's wearing our base is above 1. I said, like, we should.
I'm out of patient today. I'm too busy today.
In my opinion.
By the way, who said that 30? That's a default? Just because that's kind of
It's
this.
probably default, letting you choose that.
That's kind of weird. This system is discouraging having any money. Like, it's not really, it's too.
Well, I don't know that it's discouraging, because it doesn't make sense to be very low and you can invest it in bond, I mean, that doesn't make sense. It's not real life.
I think 8% would be more.
So-
Probably, but
Like every chart.
who's counting?
It was at certain $90 when I said, that what I wanted to It's usually 40%.
That's why everyone's saying you get it now.
I mean,
Just make a decision.
It's discounted.
Hold it.
okay, again, I don't know at this point, but I think that Amazon is
Like,
so bad.
I mean, I
I
don't
don't see
hold
it.
it. I'm already just show you guys the data.
That's why I would take the 40.
So, again, another thing is like going like 2%, 3%, that's just, nobody has.
Because I'm almost at the point where I get to be like at these prices.
He's gonna have, not get overwhelmed.
I don't know, again, maybe I'm looking at every the problem we have, those developments will come on and we do that. Yeah, I mean, that's why it's volatile.
Like, it's different from stocks, right?
It's supporting, I also it's, they say those in capex will come online. Who knows what
I feel like, but this,
I don't know, actually, I heard they didn't think about like, forecasting, and I say, oh, we can. That's what I heard. I don't know, I don't know, it's hard to me to this. Oh, by the way, one more question, Professor.
Yeah.
So, there is one company we invested that's kind of burned out or sell.
Now I understand why you need all that market.
Yeah, so I mean, this is the earning call, and it's a nuclear sector. So,
Yeah.
but they were really like, oh,
It's like a server.
so analysts are asking, oh, can you a little bit go more in details in like forecasting, and they said, oh, we cannot do it, like they really were like, oh, that was easy. It's or not?
Online test.
Well,
It's completing those tests for you.
when,
It's like so.
Jeff Skilling was Enron's president, you know,
I don't understand.
was asked for more details about earnings, etc. He actually insulted the analyst, and people were starting to ask questions, and of course we know the story. So usually it's not a good sign when someone is not, you know, at least not saying.
Not drawing a picture
That's
of
right,
our
that's
shareholder.
right, or at least, you know, try to answer and say, but there's a lot of uncertainty or something.
Yeah, but I think they also,
Question,
yeah, but I think they
shareholder
also have
expectation.
some limit, because I also listen, other ones like Broadcom, and others really want to get into, okay, why is this hyperscaler, they have a contract, and what contract they are expecting, and said, okay, we have these contracts, and these are in a Q and 5, and maybe they're on this, the try to do, like, okay, what are those? They said, oh, we cannot comment, because I think they are also because they say something, and so it's a gray line, I think, because
Yeah.
if they say too much, then they will penalize because they said too much. I think that's so, but I don't know where this line is, the optimal line, that's I try to figure it out, because they were really conservative. Broadcom was also conservative, and also check interactive rocket, but less conservative, but I don't know what kind of a good middle ground.
Yeah.
Is it free?
No,
or CL.
You know, what I,
CL.
you know, the traditional thing is for whoever is answering questions, to always put all of those,
Or call it by,
like,
yeah, I've heard of it before.
So they're making something called like a match tool?
cautious words
Yeah.
that still say something.
Yeah.
Right. When you start,
Inserting
like, coming out, that's usually not a good
Yes,
thing.
it's making you passive.
Because then you wanna get,
It's so weird, I don't know how you.
the idea is to be forthcoming as much as possible, that's
But it's
it.
not like.
And then when
it's
it's
so
forthcoming, that you might be totally wrong, you say something.
Oh.
So why the reason they're really conservative in general, because I see that it's because like,
It's at the
that would be internal information, or they practically, they say too
No,
much,
it's
and
actually-
it's
yeah,
not
it's actually-
the stock price will be really kind of, so what are they doing, they are kind of conservative, in general, but that's what I see.
So as far as the forecasting, that's easy, because the forecasting, the whole idea is to create fake surprises. Right, so you provide guidance that's very low. Ooh, it's I mean, that's part of it. Too bad we don't have, I don't think any university offers these courses, but it's something known as earnings management. That's the polite word for it, earnings management. Right, so the whole idea, first of all, is to make it as smooth as possible, avoid abrupt changes.
Oh, okay, so if they over promise,
Yes.
that would be
That's correct.
a drop, so
Yeah,
they
yeah.
don't like it because it's
Yes.
so not negative.
That's
They try to be smooth increase, that's much better on reputation. Okay,
It is
understand.
like showing like shareholders, you
Well,
are
because I
like,
think a lot of
you
the
have like
computer
expectations
stuff
for
got
one
more
year, and then
recognized.
like
Yeah,
our
we didn't have
like
homes that are
overall
working.
production or like the product we are going to launch is like
probably did
more
that on
in
purpose.
line, we are more planning for it.
Well, I don't wanna be like a conspiracy theorist, because that's.
All right, everyone, so let's get back to IBM and AT&T. So far we've looked at, you know, what could be good about these two stocks by looking at expected returns. One of them does not look so good. And then we looked at risk in the form of variance and standard deviation. And again, remember, variance is just the average squared deviation from the mean, right? So it's a measure basically of how far from the mean we could fall. And IBM does not look that good either, because it's more volatile than AT&T. So now we're gonna look at potentially something that you have not even talked about, but that might have to be considered. In fact, let me rephrase it, we need to consider, right? So here's the question. How do they tend to move together? There's only one way of doing this, statistically speaking. You literally look at every day, every month here, and every month, you're gonna look, let's say the first month, right? Take a look at this. The first month of my sample, IBM returned 0.3%, while the expectation was negative 0.2%, correct? Right? So literally IBM performed above expectations. That's good news, correct? Right? How much of a good news? Well, 0.3 minus 0.2. So I compute the difference between the actual return and the expected return. Did you do that before? Yes, when we computed variance. But I'm not elevating it to the power of 2. You guys have noticed that. I'm just computing raw difference from expectation. Why do I do this? Because I'm interested within the same month, I'm interested in looking at what happened to AT&T. So in the same month that IBM performed above expectations, what happened to AT&T? Well, AT&T returned 3.1% when the expectation was 1%. So AT&T too performed above expectations. Do we all see that? right? So both performed above expectations, so the difference from their respective means was positive. And if I were to multiply those two things, right here, if I multiply those two numbers, you guys see that's what I'm doing here? If I multiply those two numbers for that particular month, what's gonna happen? Well, the most important part is here. The sign of the product is positive. They went into the same direction, right? In that particular month. Do we all agree? Yes? Questions, comments? Now, here's the point. We need to observe what happened next. If it turns out that this is a systematic pattern, every time that AT&T is up, IBM is up as well. And every time that AT&T is down, IBM is down as well, right below expectations. If that is true, then hopefully you will agree with me, IBM is a bad investment. You know why? Because in particular, when AT&T is down, say, look, IBM is expected to do badly to begin with, negative 0.2%, correct? But now, if in addition to that, every time AT&T is down, IBM is also down below expectation, IBM makes the losses worse. That's my point. So we're trying to find some sort of redeeming feature for IBM. But if what I'm saying is true, that every time AT&T is down, IBM is also down, then actually there is no redeeming feature. Questions about that idea, right? One ideal situation would be that at least most of the time, it's not, if not some of the times when AT&T goes down, and by the way, from now on, you understand when I say going up or going down, it's not going up or down in terms of raw direction. It's, when I say going up, it's above expectations. And when I say going down, it's below expectations, correct? Right? That's what I'm saying. That's what I mean now, from now on.
So that column is practically just multiplying
So
the difference from
yeah.
the
So what I'm gonna ask you guys to do, and then we're gonna study this more in depth. But what I'm gonna ask you to do is to just do the mechanical thing for now. So first mechanical thing I want you to do, you've done it before, except you elevated it to the power of 2. First, enter this formula, right? Difference from the mean, not squared, just the difference from the mean for IBM. So for every row, for the first row, you type in equal and then the first return and then minus the average for IBM. Don't forget to dollarize the average, drag it all down. So you're gonna have that difference from the mean for IBM. I want you to do the same thing for AT&T, and then compute the product of the two columns, right? Like so, like here. Okay, I'm just computing the product of these two. So let's come up with these 3 columns, and then we're gonna discuss this further. But you need to have done this mechanically at least once in your lives, right? And as usual, once you're done, just raise your hand so I have some idea that you're done. Wow, some people are very fast. Okay. But I want everyone to do this. Again, do not skip, in particular this step, because it's going to be very critical for us. So again, compute the difference from the mean for both stocks, and then compute the product of these, the cross product of these differences.
cross product.
Yeah, cross product, because it's a product across the two stocks. Yeah. As you guys do this, some of you maybe has some time to answer this question. When I'm doing this and I'm computing the cross product, how do I read the results? Let's say on row 9, right? This was in September 30, 2011. The result was, what is the result? Negative 1.64. What?
Squared.
Percentage squared. Percentage squared. Why am I saying this? Because you should realize it's got exactly the same unit of measurement as variance. Right? Except variance is the average squared deviation from the mean. Whereas here, we're computing cross product, the cross product of deviations from the mean. So let's see, who's done with column L? This was the difference from the mean for IBM. Okay, who's done with column M? This is the difference from the mean for AT&T. And then you guys should be able to compute the product of the two, right? And this one, column N, you just enter the formula once and then once again, click as that. No need to dollarize anything. Right?
Just one question to this. Usually was the typical question, how many
No,
digits are recommended to use?
How many digits are recommended? That's a great question. By the way, you guys have noticed that I had no filter whatsoever. It's whatever, it's whatever the system.
That's why I asked it.
Right, that's a great question. How many digits? Well, at the very least, 2 decimal points, right? When you're gonna quote anything to anyone, professionally speaking, it has to be at least 2 decimal. Why? You guys know that there's a big difference between 12%, let's say in fixed income, and I don't know, 12.02%. That's like sometimes millions, if not billions of dollars. Right? So, no, you at least 2, you know, at least think in terms of basis points, right? 1% or 1%, at the very least, if not more. And at least that's my excuse for so many
Actually,
decimal points.
yeah, you also, if you change the digits on the IBM average, it's not 0.2, but 0.15, which is
It's worse.
It's
Yeah, it's not as yeah, it's not as bad as
It's a
what you
bit
mean.
different.
Yeah, certainly, absolutely. Right. All right, so who's done with the 3 columns? L, M, N. Okay. So let's talk about N, the product of these 2, right? So let's read it together, right? So in the first month of the sample, IBM, so we know when it's positive, it means the stock performed above expectations. IBM performed above expectations, AT&T performed above expectations. So the product of their difference from their own means, the cross product of these 2 things is gonna be positive. I wanna focus, let's say, on the month of June 2011. What do you guys observe?
One perform and the other they will see.
Yeah. So first of all, a negative number means that particular stock performed below expectations. Right. By the way, so I know this sounds strange at first, but with time you'll understand it. In finance, that is a loss. Right. when you, it's above expectation, that's a gain. And I know that's very confusing at first, because you think, oh, if it's a positive profit, it's a gain, if it's a negative profit, it's a loss. Wrong. And I'll explain that when the time comes. You can make money as in positive profit and still lose money. Let me explain the intuition now, and then at some point you'll see the details. But the general idea is that, you know, you have a model, or maybe some sort of equation, or some sort of a benchmark that says this month, given, for example, the risk we're taking, we should be making a profit of $1 million, right? And then at the end of the month, it turns out we made $800,000. So in the financial world, you should not open that bottle of champagne, because you lost you're $200,000 short of the benchmark. You guys understand this? Right? That's the general idea. And these benchmarks are not like random benchmarks. There are reasons why they're chosen. That's why it's serious, right? So for us, the benchmark is the expectations, -0.2% and 1%, right? Anyway, so the point is, in the first month of my sample, both stocks made money. And so the cross product was positive, correct? But what happened in June of 2011? AT&T actually lost money. How much? 1.5%. How do we know? Well, the expectation was they would make 1%, and they actually made negative 0.5%. So that's literally a difference of 1.5%. It's a loss of 1.5%. So AT&T lost money, but when AT&T lost money, what happened to IBM? It made money. You guys see that? So is this just a rare event that when AT&T loses money, IBM makes money? Well, let's look at the following month. Do you see what I'm saying? Once again, AT&T lost money even more than before. And once again, IBM actually offset that loss. It's a huge gain, 6%. Do we see the pattern? Right? And so, well, it will happen, of course, from time to time. Let's look at the next month, right? Both positions lose money. Right? But then, let's go back to the next one, the next month, same pattern once again. AT&T loses money, but IBM makes up for it in some ways. And that is the point. This is the redeeming feature of IBM. It does act as insurance. You guys see that? Right? So when bad things happen, you need the insurance policy to pay out. That's what IBM is doing. Now, it's not mechanical. Sometimes it fails to do anything. But the point is that there are enough of these occurrences where, you know, when AT&T loses money, the IBM is making up for that loss in some ways. Right? Questions about this idea, right? So that's the concept that we're gonna be after, right? The idea that a lot of times, and we're not making it up, right? The data shows it. A lot of times, when AT&T loses money, IBM, as bad as it's supposed to be, IBM actually makes up. It does make up some of that loss. Questions about this? So that's critical, right? In other words, have you noticed, that a lot of the cross products are negative, right? That's the point, right? Whenever AT&T is down and IBM is up, one deviation from the mean is negative and the other one is positive, and the product, the cross product is negative. So what we should be looking forward to is discovering a lot of these negative numbers in the cross product column. Questions about that? Because when the cross product is negative, there is an insurance effect, right? One stock is going up, going down, but the other one is going up to make up for that loss, right? And in particular, we're interested in that from the point of view of IBM, because when you look at IBM's statistics, it does not look so good. Say again?
I said that is the reason why some stock trap portfolios are not performing.
Well, see, it's okay if they're not performing as long as there's still some use for them. You know, that's the idea. That IBM is not doing well, but actually it looks like it's a good risk management tool. Let's make sure we're all on the same page. Let's talk about simple insurance, right? Regular insurance policies that you guys are familiar with. I don't care what it is, car or whatnot, it doesn't matter. When you buy an insurance policy, that's an investment, right? Money goes out, that's an investment in my book. I'm a finance person. Do you expect, when you buy insurance, do you expect the rate of return you get to be positive or negative? By the way, as you think of the answer, I'm excluding fraud from this discussion, right? So when you buy insurance policy, do you expect a positive rate of return or a negative rate of return?
Less than equal to 0.
Anyone? So raise your hand if you think it should be positive. Okay, so everyone, raise your hand if you think it should be negative. You should think something. Right? You should think something, right? So, look, who do you buy the insurance policy from? Insurance company. It's a zero-sum game. The only people involved are you and the insurance policy, and the insurance company. Why would the insurance company do business with you if they expect negative return? That does not make any sense. You guys see that, right? So they expect positive return, which means you should expect negative return. Of course, that's normal actually. That's how it should work, right? You pay, and so the return, the expected return is negative, right? Again, I'm excluding fraud, right? The expected return from buying any sort of insurance policy is negative by definition, right? And so IBM's expected return is negative. But it does act like an insurance policy, because a lot of times when AT&T loses money, then IBM actually makes up for it. So let's see how we measure this insurance effect. Right? So far, we've computed the cross product for every month. It would make sense then to summarize, once again, as a statistic, to summarize all of these observations as an average, correct? So let's compute the average of the cross products. So I'd like you guys to do that by summing all of the whole cross product and then dividing it by 59. Right? Let's compute the average cross product. And in English, you would say this is the average cross product of the deviations from the mean. And I know that's a mouthful, but that's literally the English version of what we're doing. Right? We're computing the average cross product of the difference from the mean.
The covariance?
So hold on, I did not put any name yet on it, but yeah. Somehow there's a magic title that says covar. But I'm not saying anything. I'm just saying it's the average cross product of the deviation from it. And hopefully, as you're computing that, you realize that that average, if there's a lot of insurance effect in it, that average is going to be very low, right? That average is very high if the two stocks move together all the time, right? That average is very low if a lot of times when one stock loses money, the other one makes some money. Now, of course, some of you immediately are thinking, oh, wouldn't it be even nicer if the average is so low that it's actually negative? Is that possible? Right? In other words, most of the time, the products are negative, right? So when you compute the average, it's going to be negative, right? So in theory, of course, that's possible, but you will not find stocks like that. You will not find pairs of stocks like that in practice. The best you can hope for is that this average is really low. Questions about this? Now, let me also mention, and this is something we'll talk about much later in the semester, yes, it's possible to manufacture, in other words, to make up an average cross product that's actually negative. How? By using derivatives, right? But that's not what we're doing. We're trying to use natural hedges, right? By using stocks, right? And so that's the lesson here. You can start with risk management by just looking at individual stocks and without even looking at derivatives or anything like that. You have to, you should start by looking at that. Now, the average cross product of these deviations from the mean is, just like Peter said, because that's the title one, that's known as the covariance between the two stocks, right? It's measured as percentage squared, right? So for example, here, the average is 2.91% squared. By the way, raise your hand if you've computed that average. Okay. 2.91 squared, right? Is that high or low?
Depends.
I know that, like, if I just ask you that, 2.91, so percent squared, right? How do I know that it's high or low, right? I claim that you guys have some benchmark in front of you. What is that? What are these benchmarks? It's right there. What else was measured as percentage squared?
Variance.
Variance. Have you noticed something? The individual variances are like 20 and 15. But the covariance is like whatever that is divided by 10. So it is low. It's really low. Questions about that? Right? Hope. Let's make sure you understand this. Let me ask you a question. What if instead of computing the difference from the mean for IBM and AT&T, what if I had the difference from the mean for IBM and the difference from the mean for IBM? Right?
It's the
And I
variance.
call it covar, but what is the result I would have gotten?
The variance.
The variance. The variance for a stock is basically a measure of how it moves with itself. Covariance is a measure of how a particular stock moves with some other stock. Does that make sense? Right? How does it move with itself away from its average? That's variance. So these two things are the same thing. The difference in name has to do with just indicating that you call it variance because you try to measure how it moves with itself away from its mean. Whereas here, we call it covariance because it's a measure of how each stock is moving away from its average when compared with some other stock. Questions about this? So it's called covariance, and it's low because covariance is comparable with variance. Right? It's 10 times lower, almost, right? Something like that. Now, some of you are not going to be satisfied. Actually, a lot of people are not satisfied with using covariance because it's still measured as a percentage squared, correct? Right? So here's what statisticians have invented. And you can prove this mathematically. Remember, covariance is like percentage squared, right? So actually, and remember what they do. Covariance is the average of the cross product of the deviations from the mean. So it turns out that if you, in fact, take that covariance and you divide it first by the standard deviation of IBM and then by the standard deviation of AT&T, then the percentage squared disappear. And that's known as correlation coefficient. And not only does the percentage squared disappear, but a correlation coefficient has some very nice properties. For example, the maximum value for a correlation coefficient is +1. The minimum value for a correlation coefficient is -1. So let's compute the correlation coefficient, right? Take the covariance from O2, so equal O2, and then divide it by the product of the standard deviations that you guys computed earlier. And let's make sure you get the result I get, which is literally 16.4%. Who's done with P2, correlation between IBM and AT&T? Okay, let's wait some more. I know it's late, so people are getting tired. But you still can do it. It's just a short operation, right? So the covariance is 2.91% squared, and the correlation between the two is 16.4%, right? What was the maximum value for a correlation coefficient?
1.
1, meaning 100%, and the minimum value is -1. So, what is the correlation between IBM and IBM?
0.16.
100%. Right? 100%. How do we know this? first of all, you should know intuitively. But if the intuition is not there, let's see if I can convince you. Yeah, maybe here, right? So correlation coefficient, which is written usually as a rho, right? So between two stocks, I don't know, I and J, is gonna be the covariance between I and J, stocks I and J, divided by the standard deviation of I times standard deviation of J, right? But what if it's the same stock, right? So the correlation between stock I and stock I is the covariance between I and I divided by standard deviation of I times standard deviation of I, right? And earlier on, I asked you guys what the covariance of between IBM and IBM was. And what did you say? Huh?
The variance.
It's the variance. So the covariance between IBM and IBM is the variance of IBM divided by variance of IBM. So the correlation between a stock and itself is 100%. Right? Questions about this? Right? So, the maximum correlation is 100%. So now you understand 16% is very low, correct? Anything close to zero in real life is very good. 16% is very far from 100%, correct? So IBM is still useful as an insurance product, right? That's why IBM is still worth investing into, right? Even though the expected return is negative and the volatility is very high. Questions about that? By the way, you've noticed that there are alternative ways of computing covariance and correlation coefficient. Let me walk you through that, and you should implement it now. So here's covariance, here's how you can do it. And yes, you guessed it, right? It's a function called covariance.s. And once again, whenever you use these functions, remember that the arguments are the original return, right? So covariance.s, select, open parentheses, select all of the returns for IBM, and then comma, and then comma, and then select all of the returns for AT&T, and close parentheses. So that's a way of, that's another way of coming up with the covariance between two stock returns. Questions about this? Fuang, you have a question?
Yeah, because I'm just incidentally select two columns, like column L and M.
Yeah.
I still get the same result.
So you came up with L and M,
Yeah,
and then what?
I get the same result.
Same result that I have?
Yeah.
Yeah, good. That's what it's supposed to be, right? My point here is that when you compute covariance, there's two ways of doing it. One way is you compute the average cross product or the deviations. And then the other way is you just use the covariance.s function.
But instead of using the column B and C, I use column L and M. But Yeah, but it still get the same. I'm just curious why.
For what? When you use covariance? So, you make a great point. Let me make sure we understand the difference, right? So when you use the definition of covariance, you don't use the function, but you use the definition. You need to use L and M. When you use the definition, use the definition. Covariance is the cross product of L and M. Covariance is the cross product of the deviations from the mean. So that's why you see the selection right there, right? That's why when you compute the average, it's the average of the product of the two columns, right? On the other hand, and this is my point, right? On the other hand, if you don't use that definition, but you use a function on Excel, any function on Excel immediately refers back to the original return. So here's proof, right? So here, right, in this example, it's the average of the cross products, correct, of L and M. But here, when I use this, you see the difference? I'm no longer referring to L and M at all. I'm not referring to N. I'm now referring to the original return.
But if you use the L and M, the result is the same. This is that one of my questions.
You mean for covariance?
Yeah,
That's strange.
yeah. That's what
The covariance from, you use L and M?
Yeah, instead of B and C.
Yeah, so first of all, just for the sake of clarity, it should be the original return, right? However, I mean, I don't want to go into it, but let's go into it, right? So, when you compute that same statistical covariance, but you compute it not on the raw return, but on the centered return, which is what L and M are, you should still get the same number. Because what matters is really, even when you look at the return, what matters is how they deviate from the mean. That's what gives you the information. So whether you use the raw return or the deviation from the mean, it's normal actually to get there. But I strongly urge you not to do that, right? Because it can be confusing to whoever but in statistics, that's always true. Most statistics, you can use the raw data or what's known as centered data, meaning you take each observation and remove the average, right? And that's what we call deviation from the mean. Great point, right? That's actually technically normal. By the way, guess how you could compute correlation in a different way?
Use the Correll function.
Correll function.
So just to make sure, when we're saying when we use correlation, we mean correlation coefficient.
Correlation coefficient, absolutely. Whenever you hear correlation, what's meant is correlation coefficient. The one that goes at plus 100% maximum and negative 100% minimum, right? So we all agreed the correlation between a stock and itself is, what was it again? One, right, 100%. What is the correlation between a long position, one share, a long position in one share of IBM, and a short position in one share of IBM? Huh?
0.
So I'm confused because I hear two answers, -1 and 0. So,
Zero means
Anyone?
there's no correlation. So
Ah.
there's no correlation, but the opposite. So that's why it's not
so when in doubt, just use that, right? So obviously the denominator is going to be the same, right? Because whether it's short or long, it's going to be the same standard deviation, right? So the trick is to look back at covariance, right? How do you compute covariance, right? So, right, it's covariance, it's difference from the mean. There's only one mean, right? Well, there's only one mean. Let's clarify, right? If the expected return from a long position is, I don't know, 1%, what's the expected return from a short position? It's awfully quiet. Huh? So if a long position is expected to yield 1%, right? A short position should be expected to yield negative 1%. Correct? Right. And then, when the actual return materializes, it's the same story. Right? Meaning that if the long position returns 1%, automatically the short position returns what? Negative 1%. Does that make sense to everyone? Yes? Can't tell. Right? You can't win all the time. So, there's only two possibilities, right? Either you bet that it's gonna go up, or you bet it's gonna. You guys see the point. And if you lose in one, you win in one position, you lose in the other one, right? So automatically then, when you compute the cross product, right? What's gonna happen? So the difference from the mean for one position is going to be, so the means are going to be different. Remember that, right? Right. So Cham, you're saying what?
Negative variance.
Negative covariance.
Variance.
Negative. No. Variance is going to be positive for sure.
Yeah.
But what I'm saying is that when you look at the difference from the mean, right? The mean themselves are going to be different, correct? We all agree with that. It's going to be in different directions. So let's write it down. Maybe that's going to make it easier, right? So maybe if let's say the average for the average for the long position is 1%, right? And let's say, I don't know, the actual return for the long position was 3%, right? So this is on a particular month, right? Now, if you look at the short position, right? First of all, the expected return should be negative 1%. So it's negative, correct? Right? But the actual return was what? Negative 3%, right? So here the deviation from the mean is 2%, and here, what is it? What for? It's not 4.
Minus 3.
It's really late, I know, but still. So what's the answer then? Right? So automatically, they always have a negative product. So the average is going to be negative, and there's only one possible answer, which is correlation of -1. Right? They're perfectly negatively correlated. Right? Why? It's basically there's not going to be any loss. Right? It's almost like you bought something and then you sell it right away. It's the same thing as that. Does that make sense? Right? So obviously we do not really want to do that with stocks that you buy it and you just sell it. What's the point, right? There's no point in doing that. But instead, how do you achieve this? So, for example, this would be maybe a long position in, I don't know, IBM or AT&T. And this, or something close to this, would be a long position in a put option when we get to that story on derivatives. So they have negative correlations with the underlying stocks. So you want to use that, right? Right? You cannot find naturally negative correlations between stocks. That really does not exist. But it's easy to find negative correlation between stocks and their derivatives. Right? And that's why, of course, we're going to devote a lot of time on it, a lot of time to it, right? But when it comes to just stocks between themselves, it's going to be positive, but if it's very low like this, it's very good, right? So 16% is an excellent score for a correlation between two stocks. Questions about that? Right? So from now on, always remember, there's a perfectly negative correlation between a position and its inverse, right? That's always true. And that insight, we use it because the inverse, it doesn't make sense if you buy IBM and then you short it, basically you cancel the two positions. Instead, you buy IBM and you find something else, like a derivative, that will have a negative correlation with it. Right?
Sorry, why that 16% is a good one? Because I'm just reading like
Because
0.4 is a weak or no correlation.
No. This is statistical. That's a statistical point of view. We're talking about finance. Right? So finance with real life stocks, you're not gonna find 0%.
Oh, I understand. So diversify and they're not correlated. So diversify.
Right.
So you reduce practically in your system.
So yes, literally. So literally, if you have very low correlations like this, you don't care so much about the total volatility, right? Because a lot of it is canceled by something in your portfolio. So that's the intuition here, right? So total vol, just because something goes way up and down does not make it automatically bad. That's the lesson today. IBM is really very volatile. 4.5% standard deviation versus 3.9. And the return is not good either. And yet, it's still a good investment because the correlation, its correlation with AT&T is actually pretty low. 16% in real life is really low. Right. Peter was mentioning something about correlation between 0 and what did you say? 0.04.
Yeah,
0. That's a pure statistical point of view. Yeah, that's very low. But in finance, you don't find something like that, right? Not with pairs of stocks. Any questions on the meaning of covariance and correlation coefficient? By the way, remember they measure the same thing. They just essentially what's the word? Their unit of measurement are different, right? Covariance is percentage squared, correlation is percentage. So that's why correlation is much more popular, right? Any questions about this? So if not, let's move on. So the next thing we're gonna be doing, not today, but I'm gonna start talking about it, the concept is something that looks like this. So what I've done is collect the data for expected return. So Peter earlier mentioned that the negative 0.2 makes IBM looks really bad because I chose only 1 decimal point. And he's right, because when I actually extend it to what is that, 5 decimal points, it's negative 0.15133, right? Do we all see that? Right. And then AT&T does not look so good. You know, it was 1%, remember? But the truth was, it was 0.9767%. It's just because I formatted it with so few decimal points, AT&T looked good, right? Now, the other thing I did here, so we're all gonna learn how to do this at some point, not today. The other thing I did was collect what's known as a covariance matrix. If you look back at your previous results, can someone define what we're looking at? What's on the covariance matrix here? There's 4 cells. Yeah, 4.
Yes, the variance of IBM on the top left.
Yeah.
On the F.
Yeah.
Cells, and then the opposite side, the G point F5 is the covariance between 2 stocks.
Yeah.
And the other one is the
Yeah.
variance of AT&T.
Right. So what you're gonna do at some point is learn how to compute a covariance, which already computed it, right? A covariance matrix always looks like this. On the diagonal, you have the variance of each stock. And off diagonals, just like Fong said, you have always the covariance between two stocks. And what else can you guys say about this matrix?
Symmetric.
It's a symmetric matrix. I mean, the off diagonal terms are equal, right? And so at some point we're gonna start using these matrices, like the expected return vector and covariance matrix, to start computing portfolio statistics as opposed to individual statistics, right? And I want to spend just a few more minutes before you go to start talking about that. So let me do that. So this is on in the same weeks 3, 4, 5 module, and it's going to be conceptual, and then once again at some point we will use numbers. Right? So I've already told you that a common way of coming up with projections in finance is to look at historical data, right? And these data, as you saw, tend to come up as tables, right? Like the columns of returns for IBM and AT&T, for example, right? You also know that you can look at tables as matrices. It's actually the same thing. It's the same thing, right? It's called matrix simply because it's a branch of, it's an object that was invented in math, right? But it's a table of data. That's what it is, right? But the good news is because it's invented in math, then there's been tools around those tables, right? To manipulate those tables, there's been what's known as matrix algebra. So that's what I wanna visit or revisit with you briefly before we go. I'm not gonna go too far into it. But in finance in particular, there's two matrix operations that are extremely useful. One is matrix multiplication, right? That function in Excel is mmul for matrix multiplication, right? So raise your hand if you've ever used mmul. Okay. Raise your hand if you've ever heard of matrix multiplication. So you have heard of matrix multiplication. All right. So you explain to me, you know, I give you two matrices. Explain to me, as if I didn't know, well, it's very late, so I actually don't know, how to actually multiply these two matrices. How do I do that? I know that there's two tables, X and Y. So how do I get each one of these elements of the product? Yeah, so I have to consider rows and columns, okay. All right, so I'm starting to understand it. So for example, in the results, right? If I'm interested in row 2, column 1 of the result, how do I get that result? Row 2, column 1. So I'm interested in this result. This is the result. This is row 2, column 1 in the resulting matrix, right? How do I get that? I need to look at row 2 of the first matrix and dot product it with column 1 of the second matrix. That's how you do it. But understanding which row and which column you're interested in the result is what tells you what to do. And if you were to write code, it's exactly the same thing. You have to know the result that you're looking for, and then you can go ahead with the operation. Correct? So here we have two squared matrices, right? They're like 2 by 2 matrices. And the result is a 2 by 2 product matrix, correct? Because I have to, every time I multiply, I have to look at the row of the first matrix and the column of the second matrix. What has to be the relationship between the row of the first matrix and the column of the second matrix for a multiplication to be possible?
Equal.
They have to have the same number of elements. Right? Now, how do we know how many rows the final product will have? Malcolm.
So it's a 2 by 2. We write 2 by 2 and then we take the middle part. So it means that it's going to be a 2 by 2.
Yeah, for sure. But you know, so I'm showing you guys 2 by 2 because it simplifies our thinking, right? But what I'm saying is that in general, you know, if you're gonna multiply 2 matrices that are not 2 by 2, right? How do we know how many rows the product will have?
It depends on X.
Depends on the number of rows in X. Okay? Write that down if it's not clear. Make sure you just write it down so that you can refer to it, right? The number of rows in the final product depends on is the same thing as the number of rows in the first matrix, right? How about the number of columns? How do we know the number of columns in the final product? It has to be the same number of columns in the second matrix. Questions about matrix multiplication. Now you're happy that there is a function in Excel that does it, so you don't need to know any of it. Well, actually you do, because you can end up with an error if you guys understand, right? If the X and Y matrices don't match each other, right? So, any questions on MR? Okay. The other critical matrix operation in finance is a simpler one, which is the transpose operation. What is transposing or transposition? It's just flipping a matrix. Flipping so that the first row, AB, becomes a first column. And the second row, CD, becomes the second row, CD, becomes the second column, CD. Of course, instead of looking at rows, you could look at column as well. So the first column, AC, becomes the first row, AC. You guys see that? And the second column, BD, becomes the second row, BD. Do we all see that? That's what transposition does. Questions about it? All right. So, how are we going to use this? So, here's one way of using it. When we compute, so we've computed expected return for individual stocks, correct? How do we compute expected return for portfolios? So you guys have heard of it before. It's whatever the weight on the first stock plus the return on the first stock plus the weight on the second stock times the return on the second stock, right? It's the weighted average of the returns on the two stocks, correct? You know this, you've heard this before. What is the problem? Well, the problem is no one in their right mind invests in two stocks. You want to invest in 100 stocks or something. You guys see it. So it's a problem to have to write down a formula like this. Weight on stock 1 times return on stock 1 plus weight on stock 2 times return on stock 2 plus weight on stock 3 times return on stock 3. And I'm here until 11 o'clock, right? Because I'm still writing weight on stock 100 times return on stock 100. Instead, we can use matrix operations. That's the whole idea of using matrices in finance, because it's very efficient, right? So here's how you do it. Write a weight matrix as a column. So a matrix with just one column, it's called a vector, right? That's just a name, right? And then write the same kind of a vector, but instead of using the weights, in other words, the percentage of money invested in each one of the stocks, let's write down the expected return we computed, right? Remember, we computed expected return for IBM and AT&T and all that, right? And the whole idea is this. If in fact you transpose the weight like this, and then you multiply it by the return, you do end up with the correct expression. So what did we do? Well, we actually simplified these expressions. You could have 100 terms. We simplified it into just this one. That's it. you use the same expression whether we have 100 stocks or 2 stocks. It's exactly the same. Questions about that? Right? It takes less than 1 minute to write that down. Right? By the way, you know that, maybe I should write it over there. You know that when we multiply two matrices, we can write matrix multiplication, right? And mul in Excel. And then the names of the matrices, right? Maybe let's say X and Y, right? You also know that when you transpose a matrix, you can write it like this: transpose X, right? You can write it like this, right? So my question to you is, how would you write this?
You just put the transpose function inside the other one.
Right? You have to transpose W and then multiply it with R. So you would think of it like this, but you don't write it like that, right? You would think of it like this: equal, and then you say, oh, I have to transpose W first, so somewhere you say transpose W. Right? And then what do we do? Once we've transposed W, we multiply it with R. Did we all see that? You have to have followed how I wrote it, but you can still read it though. Clearly it says multiply 2 matrices. And it says the first matrix is the transposed W. Any questions about this expression? This is true whether you use it for 10 stocks or 250 stocks. It's just the same expression on Excel. Right? So this is how efficient matrices are in finance, and why it's basically used routinely, right? No questions? Yeah, it's a good idea to write that down, by the way, right? That what I just wrote on the board. You could write it here for everyone to see, right? So you would write this in Excel. You would write this in a particular cell, and you would say equal M mul, then you transpose W, and then R, right? That's basically what I wrote. Is this clear to everyone? Yes? And again, just writing this is worth it if you have hundreds of stocks, right? You do not want to write this 100 times. It's very long. And then the worst part is this, right? You guys know that a portfolio changes all the time, correct? And the number of stocks does change. So now, if you enter the formula like this, you have to re-enter everything. Whereas here, it's the same formula. The only thing you need to change is these vectors, right? last thing I'm gonna talk about, covariance matrix. So we so far, we computed covariance and variances individually, right? And yes, we understand there's symmetry, and so some things you don't necessarily recompute, right? But if you have 100 stocks, right, roughly speaking, how many covariances and variances do you need to compute individually? So how many variances, first of all, if you have 100 stocks? 100, right? And then how many covariances? If I'm gonna exaggerate and not consider the symmetry, right? It's gonna, let me rephrase that. What is the dimension of a covariance matrix if there's 100 stocks?
100 by 100.
100 by 100. How many values?
10,000.
10,000. That's the point. Right. Now again, there's symmetry, so it's gonna be less than that. But it's still a good benchmark. Maybe there's a way of doing this without having to compute individual covariances and variances. And the answer is yeah. Let's use matrices once again, right? So here's what we're gonna do. Remember that difference from the mean? Column, we have like L and M. Well, let's call L and M together. Let's call that difference from the mean column together D for difference, right? So if there's 2 stocks in the portfolio, D will have 2 columns. If there's 100 stocks, this D will have 100 columns. Is this clear to everyone? Because we want to compute the difference from the mean for each individual stock, right? The thing is, if we have 100 stocks, you know, like I said, it looks like there's going to be 10,000 values in there, right? Maybe not the best thing to compute individually. But if you have 100 columns for D, it turns out the covariance matrix is what? You transpose that set of column, transpose it, multiply it by itself, divided by whatever the number of observations minus 1, and voila, you have everything, all of the 10,000 values in there, as if by magic. But of course it's not magic, it's math. Right? So you don't have to compute 10,000 values. Right? You basically have to write down just that very simple expression. So I'm hoping you guys will do this because I did mine over there, right? That was very complicated. Multiply the transpose W and multiply whatever, right? Here it's very simple. There's only, well, I don't know. Let's see. So the covariance matrix, if you compute it on Excel, right? So how would you write it down? It's the same idea, right? You still have to transpose D. And then what do we do with that? Multiply it by itself, correct? Yes? And then multiply the whole thing by 1 over n minus 1. Whether we're dealing with 100 stocks or 1,000 stocks, it's just the same expression. Very efficient. So of course, next week we're all gonna practice using these formulas, right, in Excel. You have to have done it at least once in your life, right? So that you feel what it is to actually compute these things, right? And then we're gonna go from there. Just so that you know what's coming up next. So what we're doing is we're laying the groundwork. You've noticed that we now know how to compute a portfolio expected return, at least conceptually. We have to do it physically next week. And we're gonna learn how to compute a portfolio variance. Because once we have this covariance matrix, look at this beauty. Yeah, we now know how to compute the variance of the portfolio. Transpose the weight, multiply it by the covariance matrix, and then multiply it by the weight again, right? Very short expression once again, right? That's the whole idea. So what's the point? Well, the point is that we need to be able to estimate, when you look at a particular portfolio, its expected return and its variance, right? We learned how to do that with individual stocks, but we learned that for individual stocks, maybe just looking at those two things is not gonna be enough, because we need, for example, to look at how they correlate with one another. That's the lesson today, right? On the other hand, when you look at a portfolio, there's nothing to correlate it with, because it's a standalone portfolio. That's the whole idea, right? So the only things that matter literally are the expected return of the portfolio and the variance. And so then the next question we're gonna answer is the following. You guys have selected your stocks and fixed income and derivatives and whatnot, right? How do you know the weights? In other words, the percentage of money that you've invested? How do you know that these are the right weights? Yeah, that's the idea. So we're gonna have at least some ways of quantifying the answer. By the way, there is an infinity of answers. That's the thing. That's the thing you need to understand. First and foremost, there is an infinity of possibilities. But we're gonna make sure that we're able to control that infinity so that we actually play with actual feasible and measurable portfolio performances, right? But that's what we're heading with this. But we have to go through matrices, and we have to be fluent with not just understanding what matrices we should be using for what, but actually manipulating at least manually, at least once in your lives. Right? So that's the idea. Questions, remarks, comments? Right? So for next week, just make sure you do two things. Based on what we've learned today, review your portfolio. Right? Did you consider pairwise correlation? Did you? I don't think so. I can tell you you did not. So consider pairwise correlations, right? And then revise your portfolio. That's number one. Then number two, review this material that we've just talked about, just to make sure you're ready to implement it next week, right? All right, that's That's all I have for you today. I will see you guys next week. Bye.
Do you like rules? One guy will be the cookies of one of the one who does all this shit.
Did you done the second question?
I can do that.
Did you done?
Not yet,
I think we should just take it on.
I think we have to cover that.
Okay, I don't know.
It's horrible. You understand? Okay, I'm not even, I'm saying. Well, yeah, no, it was never. But I would just, I think that we should do like we should get like our coral and a whole portfolio.
Because the other thing is not
What is that?
Yeah. So, yeah. It was published on Monday. Wondering,
before starting this activity, I asked
Throughout the day.
I was just curious. Yeah.
Because they asked me that.
We have that one go on the 6th.
I honestly don't know because normally, if I give an example,